Hello, everyone, and welcome to another episode of the Property Trio. Last time I said it was a very special one, and, to be honest, this isn't recorded after, so I don't know. We'll just throw it out there. I hope it is, but I know that my beautiful co-hosts have put quite a lot of effort into this one, so I suspect you'll be happy at the end. It's a big hello to Dave Johnston and Cate Bakos.
Thanks for a
Morning,
lovely
Mike.
intro.
Yeah,
Another-
I think you could describe Cate as beautiful. I'm not sure.
Oh,
if I
boys are
quite,
beautiful too.
cut the mustard.
Dave, I've always admired your angles. You're a very angular fellow, a chiseled chap.
Oh,
I love
thank
how
you
in
very
touch with your
much,
feminine side you
Mike.
are, Mike.
I know. Yeah, I'm a regular
Well,
Renaissance
I've
man.
admired your intellect.
Oh,
And
thanks.
the breadth of your vocabulary.
There's probably worse ways to say I'm ugly, Dave. You can
he's got a
set
lot
your
of hair.
watch to my hair. Yeah,
Yes.
I think I might have the world's first preceding hairline. All right. Now, we have got a listener question. Now, this chappie is going to be forever known as Ben. And he said, "Hi, team, long-time listener and lurker. Love the show, particularly Cate." Cate, you really need to stop writing your own questions as a listener.
Yeah, good on you.
We love Cate as well.
That's Cate's code name, Ben.
Yeah. No, Dave and I are just jealous. Cate, she obviously does most of the heavy lifting on this show.
No.
It's an offset account question that Ben's grappling with. He's nearing retirement and he has 3 investment properties in northeast Melbourne. Half your luck, well done. 2 of which are interest only and fully offset. The third is interest only and partially offset. He has a principal place of residence with principal and interest set up and an offset account on that one as well. He's going round and round the conundrum of whether to park his funds offset against his investment interest-only loans or the principal place of residence P&I loan. He says he fully understands the extra cash flow I get by not paying interest on the interest-only loans and effectively have the rent as taxable income. And offsetting principal and interest on the principal place of residence, there's a lot of P's and I's and PPORs here.
Yeah.
It actually makes no difference to his profit and loss unless he does something downstream, sell or refinance. He wants to hear our thoughts and he says, keep up the good work. Thanks for the question, Ben. That's an absolute cracker, and I think it falls into the sweet spot of expertise of the panel. Cate, this comes up a fair bit, and you've talked quite a lot on the show, even since I've started on offset accounts and the power of those. Yep. So he's grappling with the savings and the cash flow impact, but no tax benefits, or looking to optimize his tax benefits, but offering him no sort of reprieve on the cash flow. Can you give us the layman's term, the layman's sort of overview, the lay of the land on this one? Because it sounds quite complex because there's a few moving parts, but in essence, it's pretty simple, right?
Well, I wish it was simple. Sometimes explaining something this technical in a simplistic way is the hardest part of doing it. But let's talk about Ben's dilemma, because he's got 2 fully offset loans, which means that let's assume that he's getting 100% offset as well, which means that the lender is saying if you're paying 6%, we'll let you offset your savings and earn you 6%. So that's important to make note of. But let's assume his first 2 investment properties, they're fully offset. So he's not paying any interest on those. And obviously he's not paying principal because they're interest-only loans. So as he said, he gets the rent and he just has to pay tax on it, and that's his income. The dilemma that he has is he hasn't completely paid off his home loan, but he hasn't completely paid off investment property number 3 either. And he's got a whack of savings. If he puts the savings on the investment property, he then enjoys the benefit of not having to pay any interest on that, and he gets rent. But if he puts his savings on his home, he's still paying P&I. So regardless of the fact that he's offsetting that account, he still has a loan repayment schedule, which is what happens when it's a principal and interest loan. You have a set amount that's determined when you sign up that loan, and you pay it regardless of how much you're offsetting your account or how much you're popping into your redraw if you're using redraw as well. And let me say they're 2 very different things. The problem is, though, he's required to make that principal and interest payment, and it's a set payment. So the benefit of putting his money in his home loan offset account is twofold. Firstly, he's maximising his tax deductibility on the other property, which I'm going to leave to Dave. But also, when he's putting his savings into the offset account, he's bringing down his loan a lot quicker. He's obviously making his standard repayments, but because he's already covered off some of the interest with his savings in that account, it means that he'll finish that loan earlier than 30 years. And you can really jet your repayments, you can reduce your effective loan term quite significantly by making extra repayments or using your offset facility really effectively. Now, the issue for Ben is that when he does what delivers him optimal tax opportunity, he's not enjoying the cash flow. He's still having to make those repayments, and then he's got to deal with the repayments on the investment account as well. I hope I'm not losing anyone. It is very technical. So that's the issue that he's facing. And I think Dave's got some important points and some really good detail around these things.
Yeah, Dave, Cate's saying that you can't have your cake and eat it too, but as a strategic mortgage broker, surely, give me the cake. Hit me.
Well, yeah, look, there's always a way. We always try and find a way for people to have their cake and eat it too. And it does come down to, serviceability and different things. But, the first question I'd ask him is, does he have enough savings to 100% offset his home loan? I suspect it may be possible based on experience, given we know that he's got 2 investment loans fully offset and has another investment loan partially offset. So, generally speaking, 2 full loans of one investment property plus even a third would add up to someone's home loan. And so if the answer is yes, I would suggest that he 100% offset the home loan. So firstly, he's effectively paid off the home loan. Okay. His surplus savings would then be used to offset the investment loans. And I'd start with the one with the highest interest rate, if they don't all have the same interest rate, and then offset those. And he should do this if his income after tax deductions is greater than 18,201, which is where the lowest tax bracket kicks in. And if he's comfortable with his cash buffer, reducing somewhat if he cannot refinance and notionally needs to keep paying the principal and interest repayments on his home loan rather than interest only, which I suspect is where the issue is. So if he can switch to interest only, it's a no-brainer. If he can switch his home loan to interest only, then, that's going to obviously significantly improve his cash flow. But if he has to stay with principal and interest, but the loan is 100% offset by his savings, which means, for example, if the loan balance was 500,000, you then have 500,000 in your offset and you're paying no interest. This should significantly improve his cash flow, but there are some mortgage strategy mechanics to understand with 100% offsetting a P&I loan and the tax benefits if his salary is above 18,201. But I'm going to explain them later in the podcast.
I think Dave's touched on something really important. The first thing you said, Dave, was I've got an important question, and this is where I'd start. I too feel that way. I would much rather have more answers to my questions before making some firm recommendations. We don't give advice on this show. We use these, though, to challenge how we think about scenarios. And if I was sitting down with Ben, I'd be asking him about his income and expenses, his timeline to retirement, because one person's idea of nearing investment is different from another's. And I'd also like to know specifically why this conundrum's bothering him, so that I've got some context. It might be that he has something that he's needing to provision for on an ongoing basis, or he's got one expense that he needs to consider. And there are all kinds of options that you've got depending on what the nature of the expense is.
100%. Yeah, look, we'd certainly delve and ask more questions
Yeah.
to understand the full situation with every single client who we deal with.
Yeah.
Dave, this, I presume, is something that comes up with you and your clients fairly regularly. What stages of life do you typically see clients having these sorts of conundrums and asking these sorts of questions?
Look, basically all stages of life. I mean, all you need to have this particular conundrum is some debt on your home loan and some debt on an investment property.
Yeah.
And then, you can be in this position. I mean, it can get more pronounced later in life, because often, later in life, you can have significantly more investment debt, particularly if you're a multi-property owner and less debt on your home loan. So there can be the perception that it's my investment debts that's costing me, and that this again only and is the great impost only applies if you don't actually properly understand the tax implications, and possibly if you don't have the ability to reduce your monthly repayment on your home loan, which might be the case here as well. So again, I'm going to tackle the mechanics of that later on.
And look, what I'll weigh in there with Mike is the flavour of the day can cause this to become an issue. Let's talk about interest rate increases and the impact on an investor who has an investment loan that isn't fully offset. A year ago, this might have been a cash flow positive property regardless of the debt, or cash flow neutral. It might not have bothered him. It's probably bothering him now. I can speak from experience and talk about where my cash flow position is now compared to a year ago. And while we're net cash flow positive, it's a very different scenario overall now that we've still got debt remaining and we're feeling that.
Yeah. From a simplistic point of view, my brain always goes investment debt good, home debt bad, because I'm a tax guy, right? Like someone once told me, you can deduct the interest component on your loan, but you can't do it on your house. And to me, that was really all I needed to know. But there's nuances here, right? Because Cate's referenced one of them. Is it positive or negatively geared? Dave, you've referenced, well, what is their taxable income? Is it above the threshold? Is their income just on their positively geared portfolio, or is Ben also drawing an income from a salary or a business? So it is difficult to give generalist advice. And of course, there's a disclaimer to say that this is just general advice. You should seek an expert. I don't know why it's always in my FM radio voice. It just seems
Because
appropriate.
you can do it. We haven't got FM radio voices.
You just go a lot closer to the microphone.
I'll give it a go.
Yeah. So check out us on YouTube to be able to see all of these Easter eggs.
Idiots, aren't we?
We are.
Do you know, look, one other point that's added to the complexity only in the last sort of 4 to 6 years, I think, or maybe it's slightly longer now, is when the banks started to make home loan rates lower than investment loan rates. So until then, all the rates were exactly the same. But when APRA stepped in and started trying to put limitations on how many people could have interest-only loans, so you might recall, Westpac, for example, got up to about 35 to 40% of all loans being interest-only. And also they put a cap on the growth of investment loans for the major banks of no more than 10% per annum. At this point, the banks, to put in place APRA's requirements, started making investment loans more expensive than home loans. And so that's why now people go, but look, surely I should be paying off my investment loan because it's on a higher rate. And so this has become, a much more common conversation for strategic mortgage brokers over the last, 6-7 years since that happened.
Yeah, that's a good point. And I'd love to put a whole other episode on whether we should go back to the good old system, because I don't see a lot of evidence that there's a higher risk of default amongst investors. But that's another show, as we say. So Ben's certainly got some options, and some of the options won't be necessarily easy to roll out. If he stops working, refinancing may require employment income and serviceability calculators being happy. Guys, let's assume this is the case. Ben's got the following options. So, Cate, you've got a little bit in the can for us on this one.
Yeah, why don't I just say the high-level solution and let Dave answer all the technical part of it. The simple solution, in my view, is to refinance his principal place of residence to interest only. That solves his problem. This would let him adjust his minimum repayments with offset activity, and he'd be offsetting the right debt. How easy is this, though, Dave, and what are the challenges? Because I know it's not that straightforward with every lender.
Yeah, look, I mean, some lenders won't allow interest only on a principal and interest, on a principal place of residence on your home, or it's very difficult to get access to that interest only repayment. I suspect, given he's close to retirement, serviceability may be an issue. So, you need to show that you can pay off all your debts by the age 65, or once, you can fund it and pay them off in retirement. So, for
Yeah.
example, he's 57 years. They may not be servicing over 30 years, and they just show servicing over 30 years. It might be squashed down, the worst case, of 8 years. So
Yeah.
that means, your income needs to be 4 or 5 times as high as it normally would be to borrow the same amount. I
Yeah.
suspect there's some pressures occurring there for him. But if we go back to my original question, if you cannot refinance and extend the loan term or reduce the repayment, or switch to interest only, the reason I discuss 100% offsetting the home loan, and to be clear for listeners, an offset does reduce your repayments on an interest only loan, but on a principal and interest loan, it will not reduce your repayments. And I know you've touched on that already as well, Kate, but just to
I made a
double
mess of
down
it.
on
That's all. It was tangled. It's hard.
It is. So a mortgage broker, I suspect, what happens normally, you can't have a client who comes to you with this situation. And what's happened is some bank or mortgage broker has told them, look, they just can't do anything. Okay. But what he can do by 100% offsetting the home loan, even if he stays on principal and interest, is his overall net position will remain the same. So it basically, it works like this. So if his home balance is 500, home loan balance is 500, and he's got 500,000 in the offset, and his principal and interest repayment would be $3,000, then the home loan would come down to 497,000, and then his savings would come down to 497,000 as well. So his overall net position remains the same. And that basically nullifies. It's not really a repayment. Your home loan's paid off in full, in essence, and your home loan and savings are just coming down at the same rate.
So it's great for his assets and liabilities piece, but it's still not helping his cash flow, because he'll be channeling the savings that are fully offsetting an interest only loan that's investment and putting it onto his home loan. So the benefit here is he's reducing his home loan.
Yeah, look, it really comes down to how much. Look, I think you can consider it as a non-repayment, but you've got to be comfortable with where your buffer's at. Is the big thing for me. So that's, talk to him and say, okay, well, let's say, you've got 300,000 of those 500,000 savings currently reducing your investment debt, offsetting against those. Let's bring it over, offset your home loan. It's 100% offset. You've paid it off. Woohoo, let's high five. But trying to and go, look, ultimately it's your buffer that's coming down. But also, and this is where it gets a bit technical, it's not coming down by that full 3,000. Redraw will be building up in the home loan. Because there's no interest accruing, you're actually paying off over and above the minimum repayment. So even though the home loan comes down to 497, you might have built up $700 a redraw. So you could say, look, each time you make that repayment, there's going to be redraw. Pull that redraw out and then go and put, and definitely, put that into your offset account and then move those surplus offset funds against your investment loan. And you actually will have some surplus cash flow to do that every month.
Yes.
And then start reducing your investment loans. So again, it's technical, but, so it's not, I would say if you've got a big enough buffer, and it depends on the timeline to retirement and what your earnings are and all this sort of thing, I would try to help the person understand, in this case, Ben, it's not really a repayment. It is chewing up your buffer to some degree, but can we handle that?
Yes. So there's a little bit of short-term pain, potentially while Ben keeps working, before he starts to see this get easier and easier. And it will be like a beautiful log curve, just showing that the debt is all being extinguished and the cash flow really starts to pour in.
Yeah, and look, it'd be talking about, okay, so retirement's 8 years away. let's do the maths. How much is your buffer going to drop down to at 8 years before you access your super?
Yes.
And go through, okay, well, it's gone from 500 to 400,000 or 350 or whatever it is. And so you actually talk through those mechanics. How are you, once you get to retirement, you can start accessing, and here's what your super at. What do you think your income will be from your super? That's going to offset. You're going to have a balance of 350. Your super's actually at 1.2 million or whatever, and you talk through that and then go, okay, you can see once people understand, you have those moments as well, Cate. They go, okay, now I get it. The thing is, most banks and mortgage brokers won't talk through all these layers, so they just won't get to this point.
Yes. Yeah. Having a dashboard is everything, isn't it?
So we talked about refinancing the principal place of residence to go interest only, and there might be some challenges there. But what about, is there any value or merit in refinancing it to reduce the debt on that particular loan? Is that a deal that the banks want to make? Because obviously what they want to get whatever they can available to them over the life of that loan.
So what do you mean by reducing?
Like a complete refinance. So let's say he takes his home to another lender, home loan to another lender, and says, I've got this amount of savings and I'd like to reset my loan with a much lower loan balance.
Yeah. So that's certainly something he could do. And then he's going to lose some or all of his buffer. And again, these are all the nuanced conversations you have.
And as you said, Dave, if the banks are being ageist and they say, well, we're really concerned that we can't offer you a 30-year loan term, that's a challenge. I know from past experience that when you're dealing with a borrower who doesn't clearly have an obvious 30 years of work in front of them, you'll need to have a strategy that demonstrates how they'll retire that debt. And that might mean that Ben has to really think hard about what his living situation looks like after retirement and what the bank could be satisfied with hearing.
Yeah, and look, if you have multiple investment properties, you're normally able to demonstrate how you'd be able to retire the debt.
Yeah.
And so I suspect he'd be able to with his 3 investment properties. Again, don't know the actual numbers. So, but yeah, it's a good point, Mike. I mean, let's say he had 500,000 the home loan, and he could service 300,000. Well, you could potentially refinance that, but he's got to deal with losing 200,000 of his buffer to get there.
Yeah, it's the cake again, Dave. There's obviously there's obviously the option as well, just to keep paying down his principal and interest repayments at the standard rate, and then enjoy the less repayments over the sort of back end of the loan. Cate, that's a tricky one to sort of weigh up, and on paper it doesn't sort of seem like it fits with his scenario. What do you think?
Look, it's a case of delayed gratification. If that's the option that he goes down, it means that his retirement is being pushed further out than he would have ideally wanted it to, and not everyone is happy with that. And some people have reasons why that won't work for them. And sometimes, you just simply can't afford to delay the gratification. And I see investors making cash flow decisions that don't make the most financial sense long term. Often, pressures like we discussed earlier in the show or before we went to air, they can contribute. So whether he's got travel plans, study plans, a burning need to spend money on something significant, family members to help out, there are all kinds of reasons why people want to make sure that they have cash flow. And maybe he's just really enjoying retirement and doesn't want to go back to signing up for another 5 or 10 years of work.
Yeah, I mean, look, some of the pros and cons of refinancing is, so the pros, he'd be better off because his monthly repayment will be reduced by extending out the loan term. So, that's the big benefit. As touched on, if he stays on principal and interest, his interest rates will be better than on interest only. And that might be, he might be able to switch to interest only, but he does want to go on higher interest rates, which we haven't really talked through. If he moves all his savings to offset the home loan, he will have more tax deductions on his rental earnings. And, so that is certainly something I would recommend, and I'll explain why coming up. The cons are he could have higher interest repayments over the longer term because it takes longer to pay off his home loan. But this is only if he doesn't have all his funds offsetting the home loan,
Yes.
okay, which is his current situation. So, and again, I would recommend he have all his funds offsetting his home loan until it's 100% offset, and then start offsetting the investment loans. Compared to interest-only repayments, assuming that was an option available to him, his savings would dwindle faster, which could hamper future acquisition plans. However, given he's nearing retirement, he has some cash flow challenges. I suspect he doesn't have any further acquisition plans. The only other potential con would be the possible loss of deductions if he wants to change the principal place of residence, the home, to an investment property down the track. By reducing the loan balance, he would lose some deduction into the future. But again, feeling like the situation is he might be close to retirement, it's probably less likely. But again, these are all the things you need to talk through with your client, so then they can make an informed decision, because it's all about educating them to then be empowered to make the decision that's right for them.
Yeah, absolutely. So, Dave, the overarching important message from you relates to the fact that you think Ben should be offsetting his principal place of residence first and foremost. Can you talk our listeners through all of this?
Yeah, okay, I'll do my best. we actually see this quite a lot, and people's in all stage of life. So as long as you have debt on an investment and the home, the perception can arise that I'm better off, offsetting my investment debt rather than the home loan debt, which ultimately generally comes down to a lack of understanding of the tax implications. So mostly we find where people go wrong is they take a more simplistic approach on face value, where they just look at the numbers from a cash flow perspective and don't understand the tax benefits. But even more commonly, it's just they see the interest rates higher on the investment loans than the home loan, and so they want to pay those down. But appearances can be misleading. So look, if we do the maths, ultimately, if your home loan rate is 6.7%, and let's say your investment rate is 7%, and that's about how far they're differing mostly at the moment. It might be a bit more. So that's a 30 basis point differential. But essentially, if you're factoring in your tax rate, you need to take that off the interest rate. In essence, I mean, it's a bit more complicated than that, but that's a simple way to sort of estimate. So if Ben's earning between 45,000 and 120,000, he's paying a tax rate of 32.5%. So his true interest rate is about 4.7% after the tax deductions, not the 7%. And therefore, it's cheaper interest. And that's why he should 100% offset the home loan. And even if he's only earning as low as, after all his tax deductions, his income is as low as the bottom tax bracket of 18,250 or something like that, it still reduces. It's still a tax rate of 19% that he's paying. So, if you take that off the 7% interest rate, your true interest rate's still about 5.6% on the investment loan. So ultimately, if you keep it really simple, the interest rate on the investment loans are effectively cheaper because of the tax deductions you get on the interest.
That's a good way of putting it, Dave. Because you're right. People immediately look at that pain of, oh, that's the high one, we got to pay it off. But when you consider that tax, it's like, oh, that's the cheap loan. That's a good way. It's a good way of visualizing it.
Yeah. And I think because he's probably feels stuck on the principal and interest, he wants his cash flow being reduced, and that only works from the offsetting of the investment loans, which are interest only.
Yeah. And let's talk about the benefit of the offset on the principal and interest loans. Obviously, the direct impact that the offset has on the interest only, we're familiar with because it's calculated on a daily basis, the interest that is. And it's palpable because it represents the entire payment. This minimum repayment varies as the debt balance varies. But when we have the principal and interest with an offset, the cash flow impact is not palpable because our principal and interest repayments are predetermined and consistent. So what can we see when we look behind the curtain? It's obviously positive, but the loans that are repaid sooner with every offset dollar working for us. What else do you think Ben needs to know, guys, before we go into the gold nuggets? What if we can? I know it's a bit difficult when we talked about our FM disclaimer and not having necessarily all the information. But what have we missed that we think has given Ben enough to go and make a decision?
Look, I think for starters, understanding the power of making additional repayments is something that you can see on all kinds of websites and forums. When, for example, you've got your home loan, P&I repayments, instead of making them monthly, if you make them fortnightly, it means that you're making more repayments over the course of the year and you're reducing your loan. And that might be a significant sacrifice for some, but for most, if you're doing fortnightly repayments and each fortnight you're paying half of what your monthly repayment would have been, we all know that there's not 28 days in every month. So you end up making a couple more repayments each year. That has a significant flow-on effect over the course of the loan. It reduces it from 30 years to much shorter time frame, and that's just managing monthly to fortnightly. Then if you start paying more principal off, maybe you're making an extra $1,000 a month, and you're getting into that kind of habit, you can reduce your loan term even further. But if you start using offset, that's even more powerful. It's a turbo boost, and you can have a significant impact on the lifetime of your loan by doing that. So while Ben can't physically feel it, if he can see how quickly he's paying down his home loan by utilising his offset funds, and provided the cash flow enables him to do so, I think that's well worth a look at because it's a really powerful graph, and I'm going to include it in the show notes.
Yes, I was just about to reference the fact that there's a little Easter egg in the show notes that I think will help Ben to visualise that Cate's got from Money School, which sounds like the start of another episode. Dave, with respect to the figures in the chart, for our listeners, can you share some particular figures? Can you for people that go to the show notes, and I recommend you do have a look at this because of the power of this graphic. Can you give us an audiobook version?
Yeah, look, what I'll do is I'll just explain. So a lot of people know if you pay monthly repayments, well, you're going to take the whole 30 years to pay off a loan. Yep. If you're just making the minimum repayment. If you pay fortnightly, well, then you're effectively reducing the interest after 14 days. So rather than 30 days, you're making the full monthly repayment every 28 days. So you're paying it off a bit faster. So that reduces your repayment term or your loan term faster. But if you have 100% offset and have all your funds offsetting, it doesn't matter whether you pay weekly, fortnightly or monthly, because effectively every day you're using all your funds to reduce interest. And that's the big one, because we do get people who come to you and don't realize that in essence 100% offset account overrides any benefit of paying your repayments more regularly, because it's reducing your interest every day. And so that's the big takeaway. There's a green line on this graph that shows how rapidly an offset account and putting a big chunk of money against your home loan to start with can reduce your loan term. So that's what I'd give as the big takeaway, because that's sort of the common, a reasonably common misnomer that people don't understand, that there's no benefit to paying fortnightly or weekly if you have all your savings in a 100% offset account, because that is doing the heavy lifting with reducing the long-term, the loan term, and how quickly you'll pay it off.
I totally agree. You'll turbo boost it with the offset.
Yeah.
All right, guys, now it's time for our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
Look, my gold nugget for Ben and anyone in a similar situation is there's a few things to consider here. So let's say you can't refinance. Let's say you can't go to interest only. Cash flow is a genuine issue. Obviously, there's the tax deductions on the investment loan, which is why as long as you're earning over $18,000 after tax, it's almost always going to be better off to be offsetting your investment loans than your home loan. So that's point one. Okay, so that's the mechanics of the tax. Then point two is if he can 100% or get close to 100% offsetting his home loan, he is going to have the potential for a higher cash flow impost, paying principal and interest. But you need to think more broadly, okay? Because sometimes you are going backwards from a cash flow perspective, but it's a moment in time. Now that might be you've gone to one income because you've had kids. You've gone to 1.5 income because you've had kids. In this case, it's he has to keep paying principal and interest on the home loan, but that still might be a better solution, even though he's feeling cash flow pressure, because he might pay off that home loan in 2 years and be right as rain. Or retirement and accessing superannuation might only be 3 years or 5 years or 8 years away. And if you do the maths and look at the bigger picture, you can handle having that cash flow impost because the financial numbers are better off, even though you do feel under more pressure from cash flow, which will be alleviated once you hit retirement. And you can feel comfortable because you have a significant buffer of savings in the bank. So the point is, these things have a broader picture, and there is, in essence, like it's not financial planning advice, but it is planning your finances, and and understanding how these different things interplay with your mortgages, and it's not tax advice, but it is understanding how the tax system impacts your mortgage repayments. It's not, and when you're going to get your super, and then you can make a better decision that's right for you. But too often people only are aware of a third of the picture, if you like. And so they're not able to make a decision that could be much better for them because they just don't have the information on hand.
Yeah, absolutely. Cate?
I think that visibility is everything. As Dave said, if Ben has a dashboard in front of him and can see how much longer the cash flows might look like this, that's one thing. But understanding those cash flows and trying to optimize them through a few other means, I think is important, because he's come this far and he's got 3 investment properties and a home. He's probably set up financially, and that's all due to hard work and good planning in previous decades. So if it means that he's got a few years of tighter cash flow constraints, the first things I'd look at is budgeting. Any stuff that you can take out of your monthly budget and that won't impact you, you should be doing. Checking subscriptions, gym memberships, whatever it might be, doing a bit of a stock take on what you spend your money on with discretionary stuff. And also getting your strategic mortgage broker to see how the interest rates could be improved if they haven't already done a health check already. I know that, Dave, your team come back with surprise reductions every now and then, particularly while interest rates have increased and we're all feeling the pinch. So if he can sustain this and reduce some of the burden through these little ideas that I've got, it's all about the long-term goal. I think that's the right way to look at it.
Yeah, I love that. I think from my perspective, I wanted to finish with, I sort of set Cate the task to explain it in the beginning. It's with sort of the preface, it's pretty simple, right? Obviously that was kind of set up to fail because there's no real simple answer. Of course, we need to know all of your personal details, but there's a number of ways that you can do it, and you need to consider what you're happy with from a cash flow point of view, what you're happy with from a buffer point of view, and most importantly, what the banks will let you do, right? So Dave's talked about there potentially being some issues with refinancing as you're heading towards retirement. But my gold nugget is that it's complex and you need to lean on experts. And as much as my co-hosts are experts, don't just submit a message to a podcast. Pay for that expertise if you can, because obviously the direction you go will have a big impact on your financial future. But thank you very much, Ben, and congratulations on the success. As Cate mentioned, it's probably a hard slog to get to where you were, and we wish you all the best in retirement and with that decision.
All the best, Ben. And also, you don't have to pay for the advice if you get, work with a strategic mortgage broker as well.
There you go.
Nice
It's
to hear
even
from
free.
you. Good question.
All right. Thanks, guys. We'll see you next week.
See you later.
See ya.